Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of Microfinance and Investing, a guide to financial growth with social impact. Fostering economic growth and entrepreneurship. Microfinance serves as a springboard for small businesses in underserved areas. It enables individuals to take risks that they otherwise could not afford, which significantly boosts local economies. Job creation. As small businesses grow, they create jobs, reducing unemployment rates in the community. More jobs mean increased spending, benefiting local markets. Innovation. Financing enables entrepreneurs to innovate and introduce new products or services, which can attract more customers and stimulate economic development. Community investments. Profitable businesses often reinvest profits back into their communities, whether through local hiring, supporting education, or improving infrastructure. By fostering entrepreneurship, microfinance not only helps individuals but also cultivates a thriving local economy that can uplift entire communities. Tackling poverty through microfinance. Microfinance is a powerful tool in the fight against poverty. By offering financial resources, it helps individuals break free from cycles of deprivation. Basic needs. Access to microloans allows people to cover essential expenses like healthcare, education, and housing. This support is crucial for families striving to improve their living conditions. Income stability. With a small business, individuals generate consistent income, leading to improved financial security. This stability decreases reliance on high-interest loans or aid. Community resilience. As more people achieve financial independence, communities become more resilient. This strength helps them better withstand economic shocks or crises. By addressing the root causes of poverty, microfinance contributes not only to individual well-being but also to broader social welfare. This multifaceted impact reveals the transformative potential of microfinance in communities worldwide. Different microfinance investment models. Understanding the various investment models in microfinance is key to making informed choices as an investor. Each model offers unique opportunities and potential rewards that cater to different risk appetites and investment goals. Equity investments in microfinance institutions. Equity investments in microfinance institutions, MFIs, involve purchasing shares of these organizations, effectively giving investors ownership stakes. By directly investing in MFIs, investors can support their missions while potentially seeing returns through growth and profitability. Ownership and influence. As shareholders, investors can influence organizational decisions, ensuring that the MFI stays true to its mission of financial inclusion. Profit sharing. Investors may benefit from dividends and capital gains when the MFI performs well. If the institution expands its reach and increases lending, profits often rise, which can lead to higher returns for investors. Long-term impact. Investing in MFIs helps them raise essential capital, enabling them to provide more loans and services to underserved communities. This growth positively affects social change, which resonates with socially conscious investors. Investing in MFIs through equity is not only about financial returns, it's also about being part of a movement aimed at uplifting communities. Debt investments and microfinance funds. Debt investments in microfinance are often structured through microfinance funds. These funds collect money from numerous investors and lend it to MFIs or directly to borrowers. This pooled approach helps spread risk and offers a more diversified investment strategy. Fixed income. Investors receive interest payments on the loans made by the fund. These interest rates can be attractive, typically ranging from 4% to 12% annually. Lower risk. By participating in a fund, investors share the risks involved with lending. This model can cushion against defaults since the fund diversifies across multiple loans and borrowers. Accessibility. Investors can contribute smaller amounts than they would if investing in a single MFI. This makes microfinance more accessible to individuals with varying investment capacities. Debt investing offers a structured way to engage with microfinance while generating predictable returns and contributing to the financial ecosystem. Peer-to-peer microfinance platforms. Peer-to-peer microfinance platforms, like Kiva, allow individuals to lend directly to borrowers in developing regions. This model removes intermediaries and connects lenders with entrepreneurs seeking funding. Direct connection. Lenders see exactly where their money goes. They can choose specific projects or individual borrowers, fostering a personal connection to the impact their investment makes. Social returns. Many lenders feel a profound sense of satisfaction from helping others. Knowing that their funds support small businesses can be more rewarding than traditional investment models. Lower minimums. Platforms often have low minimum loan amounts, allowing individuals to participate with modest sums, making it easier to get started with microfinance investing. Peer-to-peer platforms leverage technology to create community-driven financing. They allow individuals to be part of the solution, empowering borrowers directly while potentially earning a small return on their investment. By exploring these microfinance investment models, investors can find a pathway that aligns with their financial goals and social values, contributing to meaningful change. Challenges and criticisms of microfinance. While microfinance has changed many lives for the better, it also faces significant challenges and criticisms. Understanding these issues is essential for anyone considering involvement in the microfinance sector, whether as an investor or a stakeholder. This section highlights key concerns related to microfinance operations, shedding light on the complexities of this impactful financial approach. High interest rates and over-indebtedness. One of the most pressing concerns surrounding microfinance is the high interest rates charged by microfinance institutions, MFIs. Borrowers often end up paying more than they initially expected, leading to over-indebtedness. Affordability issues. Many MFIs set interest rates that can range from 20% to 60% annually. While they argue that these rates cover operational costs, borrowers may find themselves unable to manage their repayments. Cycle of debt. Those who cannot repay their loans often borrow more, creating a cycle of debt. It's a precarious situation where a borrower's financial health spirals downward, leading to severe consequences, like loss of assets or increased poverty. Lack of transparency. Borrowers may not fully understand the terms of their loans. If they feel cornered into borrowing, they might not realize the financial burden until it's too late. Addressing these concerns is crucial for making microfinance a truly supportive tool for economic improvement. Ethical concerns in microfinance investing. Microfinance investing raises ethical questions regarding exploitation and fair practices. Investors often grapple with the moral implications of their financial support. Predatory practices. Some MFIs have been accused of targeting vulnerable populations and employing aggressive collection methods. Investors need to consider whether their funds support institutions committed to ethical growth or those that prioritize profit. Lack of regulation. The microfinance sector isn't uniformly regulated. This variability can lead to predatory lending practices, where institutions exploit borrowers without oversight. Social impact versus profit. Investors must balance their desire for social impact with potential profit motives. When financial returns overshadow the mission of uplifting communities, the integrity of the microfinance approach comes into question. These ethical concerns challenge the perception of microfinance as a straightforward solution and highlight the need for careful scrutiny. Mismanagement and lack of regulation. Mismanagement and a lack of regulatory oversight can also hinder the effectiveness of microfinance. Case studies of mismanagement. Several MFIs have faced scandals related to poor governance, lack of transparency, or allegations of fraud. Instances of mismanagement not only hinder their operational ability but also diminish borrowers' trust. Regulatory gaps. In many regions, microfinance operates in a gray area with insufficient regulation. This environment can lead to inconsistent practices and raise questions about the sustainability of the institutions involved. Accountability issues. Without strong regulatory frameworks, it becomes difficult to hold MFIs accountable for their practices. Borrowers may have no recourse if they fall victim to unfair practices, leaving them trapped in a cycle of debt. Examining these management and regulatory issues is essential for understanding the potential pitfalls of microfinance as a financial strategy. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.